the end of World War I heralded a new era in the United States. It was an era of enthusiasm, confidence, and optimism, a time when inventions such as the airplane and radio made anything seem possible. It is in such times of optimism that people take their savings out and invest it. In the 1920s, many invested in the stock market. Although the stock market has the reputation of being a risky investment, it did not appear that way in the 1920s. With the mood of the country exuberant, the stock market seemed an infallible investment in the future. As more people invested in the stock market, stock prices began to rise. In 1928, the stock market had become a place where every day people truly believed that they could become rich. Discussions about stocks could be heard everywhere. Although an increasing number of people wanted to buy stocks, not everyone had the money to do so. When someone did not have the money to pay the full price of stocks, they could buy stocks on margin. Buying stocks on margin means that the buyer would put down some of his own money, but the rest he would borrow from a broker. However, if the price of stock fell lower than the loan amount, the broker will likely issue a margin call, which means that the buyer must come up with the cash to pay back his loan immediately. By early 1929, people across the US were scrambling to get into the stock market. The profits seemed so assured that even many companies placed the money in the stock market. With the stock market prices upward bound, everything seemed so wonderful. Until March 25th, the stock market suffered a mini crash. This mini crash was nearly forgotten as the market surged ahead during the summer of 1929. From June through August, stock market prices reached their highest level to date. 2 days later, the market started dropping. Stock prices fluctuated throughout September and into October until the massive drop on Black Thursday. On the morning of Thursday, October 24, 1929, stock prices plummeted. Vast numbers of people were selling their stocks. When a group of bankers pooled their money and invested a large sum back into the stock market, their willingness to invest their own money in the stock market convinced the others to stop selling. Although the market had closed on an upswing on Black Thursday, the low numbers of the ticker that day had shocked many speculators. Hoping to get out the stock market before they lost everything, they decided to sell. This time, as the stock prices plummeted, no one came in to save it. As the result, many people ended up with suicide and many factories closed. The stock market crash of 1929 was the beginning of the Great Depression.